If you've been following this series, you'll know that remortgaging is a priority for many people right now, and you may be one of them. With interest rates on the rise, you might be wondering whether changing your mortgage could be the key to saving money in a cost of living crisis and, of course, gaining some financial stability. Well, a lot comes down to what kind of mortgage you choose, and there are perhaps about a dozen different types out there. So in this episode, I wanted to give you an overview of the choices that you're going to be facing. Which one is right for you very much depends on your own personal, unique circumstances, and this is where it's really worth consulting an expert mortgage advisor. Our preferred partner has access to more than 12,000 deals from over 90 different lenders. So whatever type of mortgage you need, they'll certainly be able to steer you in the right direction and help you with the process and these big decisions. There's a link in the description below so you can get connected. Right, now let's enter the mortgage maze. The first and the simplest choice is between a fixed rate mortgage and a variable rate mortgage. With a fixed rate one, the interest rate and therefore your monthly payments remain exactly the same for a set period of time. Fixed rates tend to be for 2, 3, 5 or 10 years, and lenders offer different rates of interest depending on how long you fix for. This makes budgeting much easier as you know exactly how much your repayments are going to be each month for the whole duration of the fix, and then you can plan accordingly. Crucially, you are protected if interest rates go up, but the downside is that you'll miss out on savings if interest rates go down. And if you want to exit the deal before your term is up, the chances are you'd have to pay an early repayment charge. I'll be talking more about these in our next episode, so make sure you subscribe and hit that alert bell. Next up, with a variable rate mortgage, the interest rate you pay is likely to change if the Bank of England changes its own base rate. With some variable rate deals, the lender can change the interest rate even if the base rate was to stay the same. Variable rate mortgages mean your repayments can change from month to month. You'll benefit, yes, from any fall in interest rates, but you'll pay more if and when interest rates were to rise. These deals often come without early repayment charges, so if you want to change to another mortgage product or another lender, you won't have to pay to leave your current deal. But did you know there are several different types of variable rate mortgage? I said it was complicated. The first is the standard variable rate, or SVR. The SVR is set by the lender and can change at any time. And this is the rate of interest that's usually charged by your lender once your fixed rate or other mortgage deal ends. The next type of variable is a discount mortgage. For example, if the lender's SVR is 5% and the discount rate is 2%, your interest rate will be 3%. Because the discount rate is linked to the SVR, if the SVR goes up or down, so will your repayments. But if the discount is 2%, the rate will always be 2% below the SVR for the whole length of the deal. You got that? After this time, the interest rate on your mortgage reverts to the SVR. You may also have heard of tracker mortgages. Trackers are pegged to the Bank of England base rate, and so you might see something like base rate plus 1%. So if the base rate is 3.5%, you'll pay 4.5%. If the base rate drops to 3%, then your interest rate drops to 4%. Simples. The next option is whether to choose a repayment mortgage or an interest-only mortgage. With a repayment one, the lender works out the calculations, so each month you'll pay off the interest on the loan plus a bit of the capital. As time goes on, it follows that you owe less because you're paying off a little bit of the capital each month. So the interest accrued is smaller and your repayments get less as time goes on. At the end of the mortgage term, you'll actually have paid off everything that you owe and own your home outright. Whereas with an interest-only mortgage, your monthly repayments only pay the interest on the loan. This means your payments will be cheaper, yes, but of course at the end of the term, you'll still owe all the money you originally borrowed. Generally, homeowners pay off their interest-only loans by selling the property. However, if house prices drop, your home might not fetch enough to pay off the loan. It can happen. With the property market adjusting as it is just at the moment, it's definitely a risk to factor in when deciding which mortgage to go for. And finally, there are the specialised mortgages, things like buy-to-let, first-time buyer mortgages, shared ownership mortgages, lifetime mortgages for homeowners over the age of 55, and even green mortgages for energy-saving homes. You will find more information about all of these on my MoveIQ website, so do please check that out. It's moveiq.co.uk. Join me next time when I'll be asking whether it's time for you to remortgage. Please do remember that your property may be repossessed if you do not keep up repayments on your mortgage. You may have to pay an early repayment charge to your existing lender if you remortgage, and individual savings may vary. Your savings will depend on personal circumstances.